Okay, so here's the real question.
Right.
If things are bad as crazy right now, and you are a trader,
right,
not necessarily even a long-term investor, but a trader, let's just say you're thinking about where to put your money. I'd actually love to hear about it in the context of being a trader, but also actually as a long-term investor. What are you supposed to do in this environment?
John Tudor Jones. You may not know who he is, as he keeps a relatively low profile when compared to other household names like Michael Burry, Warren Buffett, and Ray Dalio. Not too long ago, Jones made his mark on Wall Street predicting one of the worst stock market crashes of all time, 1987's Black Monday, a prediction that made him a billionaire and cemented his legacy on Wall Street. Recently, however, Jones has been out of the spotlight, rarely granting interviews or making predictions. 1 week ago, on June 17th, Tudor Jones appeared in an interview with CNBC, and his comments were simply shocking. Since price hikes around the country have made inflation go mainstream, it was not a surprise to hear this topic being discussed, but it was his plan to action that really shined the light on what he expects out of the economy in the near term. Take a listen to this first clip.
Well, I'm going to watch the Fed on Wednesday. If they treat these numbers, which were material events, they're very material. If they treat them with nonchalance, then I think it's just a green light to bet heavily on every inflation trade. The idea that inflation is transitory, to me, is that one just doesn't work the way I see the world. So I look at $88 trillion of assets under management by asset managers. Of that, $670 billion are invested in commodity indices like Bloomberg Commodity Index, Goldman Sachs Commodity Index. That's about 0.75%. If I rewind just to 2011, when inflation was peaking at 3%, not CPI at 4.9, those same investors had 1.2% of their assets, which would imply today, if they just got back to weight, another $400 billion of buying in commodity indices. And if you, certainly the impact models that we run would argue that GSER or BCOM would double or triple.
Okay, so before you click off the video and call this an extremely boring take filled with complex acronyms and math, I just want to let you know that what he said is one of the most simple and scientific ways to explain why you should be investing in inflation hedges. Tudor Jones is basically saying that if we take a look at assets under management and look around at the smart money in the room, the pro traders and institutions, back in 2011 when inflation peaked at 3%, they had about 1.2% of all their money in commodities, things like Bloomberg's BCOM. This is just a fancy way of saying that they had 1.2% of their money spread out on things like steel, lumber, corn, and physical raw materials. Now the point of this is that right now, with the official CPI rate or the official annualized inflation rate being at 4.9%, they only have 0.75% of their money in commodities. So why is this different this time? It seems to him that the smart money is behind and needs to get with the program and realize just how much inflation is out there. He claims that if this 0.75 moves to a more normal level, one that is in line with historical trends, well then commodities would jump significantly and indexes like the BCOM would double or even triple. So why is the smart money not allocating enough investment to protect themselves against inflation? Well, Tudor Jones thinks it's because of this. But before I show you his answer, please smash that subscribe button if you're enjoying the content. Thank you.
If I just look at where asset managers are, 60-40 types, the one thing that they should be invested in, they're not invested in, probably because they're hearing these assurances that inflation's transitory. So you've got this massive short, really, in the commodity complex, a massive short there. So that makes me think that, and I'll look at the balances in a variety of commodities, and they're all so razor thin. They're all so razor thin. And this is just what happens if institutional money would get to where they should be, given the level of real rates. What happens if the Reddit crowd ever gets into commodities? God forbid if the bullies, the financial markets, ever were to take it on, for instance, like retail did back in the 70s.
Now this is my favorite clip. A billionaire hedge fund manager afraid of the Reddit crowd. So just to break down exactly what he said, he thinks the institutions are not pouring enough money into commodities because they're accepting the Fed explanation that inflation is just transitory. We've heard this many times in the last month or two, but as you know on this channel, we think it's very likely not the case. And you can look at all my other videos explaining why this is most likely BS by the Fed. Now, once inflation opinions move from temporary to permanent, Jones thinks that institutional money should flow in and really move the needle on some of these prices. But it's the next phrase that really got the most attention. He states that God forbid the Reddit bullies start shaking up the commodity markets and references the 1970s as an example. We can see what he means by looking at the price of wheat for the last 40 years. One period in particular stands out, a giant boom and bust. In 1972, the price of 1 bushel of wheat was $1.44. By 1974, it was nearly $6.50, a price hike of nearly 450%. If you Google the reason why, you will see a couple of explanations, but to many people, this extreme price jump was caused by a catalyst which included the great grain robbery, followed up by pure speculation and gambling in the markets. Once prices get going and people start making money, prices can really balloon out of control. This in the commodity markets can be extremely troubling not only to investors but to common citizens around the world. These massive price moves in the early 1970s caused food prices to soar 30 to 50% in just 1 year. When you start thinking about the consequences of such a move, the reality becomes a little more morbid compared to price inflation and other things. Sure, you can short squeeze GameStop and cause billions in losses for the hedge funds. It really won't affect the average man or woman. But when speculation begins pushing prices in commodities, the effects can quickly flow down to normal, everyday people. Not only do commodity hikes cause food inflation, but they also drive prices in various other markets, leading to a serious inflationary mindset that can quickly get out of control. Jones continues with this warning.
What I mean is that commodities are finite supply, small markets, generally speaking. And if we ever get an inflationary psychology, like for instance, we did when I was in my 20s, back in the 70s, if we ever get that again, and if you ever got retail actually nervous about inflation, then the one thing that leads inflation, which is commodity prices, it's the easiest tautology there is, those things can literally scream double or triple with no problem whatsoever.
So in summary, if you think the Federal Reserve is lying and inflation is indeed not transitory, moving a bit of your money into commodity indexes wouldn't be a bad idea to protect yourself against this oncoming wave of inflation driven by things like this. Don't forget, if you're enjoying the video, please consider subscribing to see more content like this. And as always, thank you for watching.